Welcome back to LinkedIn Editors Live at the Milken Institute Global Conference in Los Angeles. I'm Devin Banerjee, and I'm joined now by Tyler Dickson, the Global Co-Head of Banking, Capital Markets, and Advisory at Citigroup. Tyler, thanks for joining us.
Good morning. Great to be here.
You sit in the center of IPOs, mergers and acquisitions, capital raising. Let's touch on all of those. Let's start with IPOs, Tyler. What's your outlook for IPOs this year, both by volume and by sector?
We are cautiously optimistic about the IPO market. As you know, we started off on relatively low volume, and that was really the result of the financial disruption that occurred in the fourth quarter of last year. I think when we look around the world, the first quarter was light in terms of activity, down about 65%. So a really quiet period. That was in part due to the volatility I mentioned. It was in part due to concerns about the direction of economic growth. And in part, it was also due to the government shutdown, which slowed down some IPOs coming to market. As we look forward, we see a robust pipeline. We have over 100 deals in the pipeline at Citi across the globe, and we've seen IPO activity pick up. In the last month, we've seen global IPO volumes at roughly the same pace that we saw for the first quarter. And so that's a big pickup in activity. We're seeing it in the places that you would expect. The market's excited about growth, and so we're seeing activity from tech, we're seeing it in healthcare. We would expect that to continue. What's been exciting for us at Citi is we're not only seeing the US IPO market start to be active, but Europe and Asia are active as well.
Do you get a sense, Tyler, as we stretch late into this market cycle, do you get a sense from your clients that there's a window that may shut and they need to think about whether to IPO before that window shuts?
That is always a consideration in the IPO market. It's a high volatility market. I think investors are really focused on fundamentals right now. I think after a bit of volatility that had the markets be quite cautious, we've come back and the markets are quite confident in at least the short-term prospects for growth. There's a general consensus that interest rates will be low in the short term. There's a general view that there's going to be economic growth and not a near-term recession. We, as a result of those dynamics, have seen equity values increase significantly. And so there's a lot of enthusiasm for equity, and the IPO market is a great way to get exposure to the equity market at a discount.
Right.
We're seeing three trends that we think are important that give us some confidence. One is volatility in the market has settled down. So the VIX is at an all-time near low. That makes the market stable for bringing new names. Second, we've seen a convergence of investor confidence that economic growth is ahead of us. And third, we've seen generally the IPO market working. Now, we have to be careful when we say generally because the IPO market is made up of idiosyncratic individual deals and not all of them work.
Let's talk about more traditional deal making, mergers and acquisitions. What's your outlook for the year in M&A, and what sectors are really hot, and what are some themes driving those?
Just like the IPO market, the M&A market's being driven by the constant quest for growth. The activity that we've seen this year has been robust, but not nearly as robust as last year. So by comparative standards, we have the fourth best start of global M&A activity in market history. So that would give you some confidence that there's good fundamentals at work. Having said that, compared to the extraordinary robust activity we saw last year, it's down, and so we have to take that into consideration. We would say that we're expecting the M&A market to be good versus great. Now, we're very active, and the market's very active on very large transactions. So in that $20 billion category killer transaction, we're seeing more of those transactions in this environment than almost any other period of time. They're exciting, they're complicated, they grab headlines. Where we're seeing less activity is in the $1 billion to $10 billion arena. And that is sort of the sweet spot of activity for banks, and we hope that picks up. Now, the activity levels continue to be in exciting sectors, as you would expect. A lot of healthcare, a lot of tech, any opportunity that companies have to seek growth. If they can't get it organically, they have to look to the M&A market.
Yeah.
They have to be careful in this environment because the equity values that I just talked about, which are driving enthusiasm in the IPO market, are very lofty values. And so we have seen our corporate, our financial sponsor, who are the most active clients in the M&A world, being prudently cautious about valuations and prudently cautious about the price they will pay for growth. Now, we're seeing growth not only in the US markets around tech and healthcare, we're seeing that phenomenon globally. We're also seeing old economy areas like industrials and energy doing deals that are more defensive. We're in an environment where you either need to grow offensively
Or
you need to be prepared defensively if you can't grow to protect returns for your shareholders.
Yeah, that's a great point. Tyler, we've seen some emerging drivers of M&A in the past, call it decade. One of which is shareholder activism.
Sure.
Where are we in this evolution of shareholder activism, and is this a permanent trend now?
Yes, Citi would, and I would say that shareholder activism has gone mainstream at this point. It's institutionalized itself as an asset pool. Activists have enormous pools of capital to go after the strategies. They're an active part of the markets, and they're being welcomed by pension funds and mutual funds and other market participants as discipliners to the corporate agenda. Now, we think they're an important part of helping companies sharpen their focus on what their prospects are and driving shareholder value. They're not only activists today, there are constructivists, which are interested in being more helpful than disruptive. But I think we're in an environment right now where disruption is invading and pervading every part of the marketplace, and activists are part of that equation. We would expect activists to continue to be an important part of the market for the foreseeable future.
Tyler, we see both activists as well as corporate leaders thinking a lot more about ESG these days, and it's a big theme at this year's Milken Institute Global Conference. Do you think we'll ever get to a point where certain M&A transactions are driven by ESG considerations?
We do. Now, this is a top priority for Citi, and we've been really focused on sustainability and ESG as an important part of the dialogue we have with our most important clients. It's topical to our CEOs, it's topical to our boards. Frankly, in the financial services, it's topical to what we do. So from our perspective, we're not only talking about it with clients, we're taking those strategies seriously. Most recently, we did our own green bond as a small example of that. And I think that's a demonstration that Citi's eating our own cooking in doing responsible finance, not only for our clients, but for ourselves.
You mentioned financial sponsor activity, which is code, if you will, for private equity-driven transactions. That world of private equity and that pool of capital has just swelled to trillions of dollars over the past decade. What's your outlook for private equity-driven transactions? Is that asset class just going to continue to grow?
It is cashed up. It has a lot of smart people who are going to find interesting opportunities. So we think they're a critical component. At Citi, we would say we're right now in the rise of LBOs again after a period where they were much less influential.
LBOs being leveraged buyouts,
Leveraged buyouts, that's correct. So private equity firms as purchasers of assets as opposed to corporations. And we would expect that to continue. We have benign financing, so cheap financing from the banks and also from direct lenders. We have lots of equity and cash available to invest. The only area of sensitivity, just like our corporate clients, financial sponsors are being disciplined about what is a fair price to pay for growth in this environment. But we expect them to be active and they're a core part of our constituency.
Absolutely. Tyler, I want to jump back to the IPO market and more specifically direct listings, which we've seen a couple large players taking that route. Why have they done it, and will we see more of those?
That's a great question. I think we will see more of them, but that's a pretty specialized solution. Most companies want to raise capital through an IPO and therefore take capital in order to accelerate their growth. Examples of those would be the Lyfts or the Ubers of the world. Companies that have raised capital multiple times in private rounds and look and really act a lot like a well-financed public company that don't need capital from the public markets are rare. But on those rare occasions where we have those, they tend to be unicorn-type companies that are cash positive and cash flowing and don't need new capital. Those are the most likely candidates for those listings. Now, when we also spend time with companies who could do an IPO or do a direct listing, there are a number of companies that even see the benefit if they don't need cash and instead are building a shareholder base, that they would choose to do that in a more conventional IPO format. We look at the landscape and see traditional IPOs, direct listings, new vehicles like SPACs as alternative forms of capital that can help companies get public and give new investment opportunities to our investing clients.
Yeah. Final question, Tyler, from our audience. Obviously, boards of directors have to agree to terms of a transaction. You as advisors help guide those terms, but are you concerned about valuations, both in the IPO market and the M&A market? Do things seem like they're getting toppier?
It's hard to argue with multiples as stretched as they are to say that a certain degree of caution isn't appropriate. At the same time, we would say that we feel comfortable given the economic outlook, the prospects for the deals that we're working on, and the boards and CEOs that we're advising, that we think the transactions that we're focused on make sense. I think you have to be careful in this environment, but you also have to move forward. And in an environment that rewards action, in an environment where we see massive transformation and disruption occurring, if our corporate clients and our financial sponsors aren't moving proactively, they run the risk of being on the wrong side of history.
Sorry, Tyler, final question from our stream. Are geopolitics a larger consideration in the global capital markets now? And do you think, especially for investment professionals, people who are entering this industry, do you think everyone needs to understand geopolitics at a certain point?
Look, there's no doubt that macroeconomics and the influences of geopolitical trends, both globally and locally, are hugely important. I think at Citi, our business model in serving clients is we're in over 100 countries, and we have the benefit of looking at those dynamics, both geopolitical and economic. I think what's important is you have to be able to translate those into, so what does it mean for the client, and how can they take advantage of those risks and manage themselves carefully so that they're opportune against them, and how can they capitalize on growth in that environment? So we think geopolitics is here to stay. We think the world is getting smaller. We're in an environment where, while the world's getting smaller, some of the trends like global trade, some of the trends like communication and multilateral engagement with economies around the world are under stress due to populism and other trends, and we have an opportunity to work through that and help advise our clients how to play those important trends.